Welcome to the deep dive. Today we're diving into the really complex world of industrial infrastructure.
Right into the thick of it.
Exactly. We're putting the spotlight on a massive global player, Toyo Engineering Corporation. That's TEC, stock code 6330.
A major name in EPC.
Our mission is to cut through the usual corporate talk, understand the, let's say, recent volatility they've faced, and figure out how this, established company plans to use digital transformation to tackle the carbon neutral or CN era.
Yeah, TEC's a fascinating case. Japanese firm, founded way back 1961, and they are truly experts at building huge industrial plants.
We're talking massive scale here.
Oh, yeah. Fertilizer plants, that's kind of their historical sweet spot. Deep technical roots there, oil and gas facilities, power systems. They operate in over 60 countries.
Wow.
But the big challenge now, as you said, is that EPC model. Engineering, procurement, construction, it's just inherently high risk.
And they have to adapt it fast, right? With this global push towards carbon neutrality changing everything.
Precisely. That's the core tension.
Okay, let's unpack this then. We've seen materials outlining a pretty radical strategy shift, some significant financial hiccups recently.
Definitely some bumps in the road.
And this almost, sensational goal of achieving a six-fold increase in productivity. That really jumps out.
It does catch the eye.
So before we dig into the markets and the financials, what really defines tech? What's their identity? And how is the leadership trying to pivot away from that traditional high-risk EPC image?
Well, their core identity, historically, is all about combining super specialized technical know-how, like licensing a specific chemical process, say for ammonia or urea,
Right.
and marrying that with the huge logistical challenge of actually building that plant wherever it might be in the world. Procurement, construction management, the works.
But the current leadership sees a need to change that formula.
Exactly. The current president, Eiji Hosoi, who took over in June 2023, he's really trying to shift the whole philosophy.
He's got that hands-on experience, right?
Yeah.
Turned around their Indonesian subsidiary, IKPT.
That's right. IKPT was a challenging situation, and his success there clearly informs his approach now. He brings that deep international ground-level perspective.
So what's the core message he's pushing? What's the big change?
It's a really fundamental shift, and honestly, it's relevant for the whole EPC industry. He's pushing tech away from being the lone EPC risk taker.
You mean those big fixed-price contracts where they absorb all the unexpected costs?
Exactly, the turnkey lump sum contracts that can absolutely destroy your margins if things go wrong. He wants tech to be more of a collaborative partner.
The co-creation engineering concept.
That's the one. Okil-ses, as they call it. Sharing the risk, working with the client, not just for them under immense pressure.
Which makes a lot of sense, doesn't it? Especially now with unpredictable material costs, labor shortages. It feels like a less brittle model.
It absolutely does. But the big question then becomes, if you step back from those huge lump sum risks, how do you maintain the kind of profitability that often comes with those giant projects?
Right, there's always a trade-off.
And that trade-off is kind of baked into their midterm plan, the one running from 2021 to 2025. They call it the green and blue strategy.
Green and blue. Okay, break that down.
So blue is about strengthening their traditional EPC business, making it more efficient, more predictable, basically de-risking it.
And green.
Green is the future-facing part, developing totally new technology and business models. This means moving beyond just building standard chemical plants and selling more high-value stuff like complex know-how, digital services, CN solutions.
Okay, and that connects back to the headline goal we mentioned, that huge 6x productivity jump by 2024 or 2025. That sounds like it belongs more in the blue category, strengthening the core EPC.
It primarily does, yes. It's about making the core execution way more efficient. And honestly, for a company dealing with concrete, steel, massive physical construction, how do you even get a six-fold leap? It sounds a bit like marketing hype.
It does sound ambitious.
Until you look at how they plan to do it. It's all pinned on DXoT, the digital transformation of Toyo.
Right, DXoT.
The core idea is shifting from what they call document-centric operations. Endless paper trails, manual sign-offs, traditional handoffs between departments.
The old way, stacks of blueprints.
Exactly. They want to move to data-centric operations, fully integrated digital workflows.
So like a complete virtual model of the plant.
Pretty much. They're implementing something called the Engineering Digital Twin, or EDT. It's a virtual replica that follows the project from the earliest design phases right through construction and even into operation.
And the benefit isn't just speed, I assume.
No, it's about eliminating waste and errors. Think about catching design clashes before steel is ordered, reducing change orders during construction because the plan is just better, minimizing rework. That's where the big savings are.
And they have tools to monitor this in real time.
Yeah, they mentioned systems like FM8, which provides real-time visualization of construction progress against that digital model. The whole 6X idea rests on minimizing errors and maximizing predictability in the physical build by perfecting the digital blueprint first.
That makes sense. Moving from analog documents to live data is
Yeah.
key for managing risk in these massive projects. Okay, let's shift to the physical world then. You mentioned 16 sites, 11 countries. Where are we seeing this green and blue strategy play out most clearly on the ground?
Well, the global south is absolutely crucial for them. India, for instance. Toyo India is now a major hub.
Not just for Indian projects.
No, for global project execution. Handling complex design work, procurement support, across different sectors too. Ammonia, ethylene, even those high-value FPSO projects we'll talk about.
And why India, strategically?
It's a long-term bet. Massive population, huge economic growth potential, projected to be the world's third largest economy by, what, 2027?
That's soon.
Yeah. So the demand there for basic materials, chemicals, refining capacity, infrastructure, it's just going to be immense. Tech needs to be deeply embedded there.
And then there's Indonesia, which you mentioned earlier, where the CEO Hosoi made his mark. That seems key for their green ambitions.
Absolutely. The subsidiary IKPT is right at the forefront of their energy transition work. Indonesia has huge geothermal potential.
Right, volcanic country.
Exactly. So IKPT is pushing this geothermal carbon-neutral park concept. They want to help significantly boost Indonesia's geothermal capacity by 2030. And, crucially, they're doing green ammonia feed studies there.
Okay, hold on, feed study. Let's clarify that for everyone listening. What exactly is feed?
Good point. It's important jargon. FEED stands for front-end engineering design. Think of it as the detailed blueprint and planning stage. It's where you do all the critical analysis, the conceptual design, figure out the core technology before you commit to the massive cost and risk of full construction.
So it's the brain work, the high-value, low-risk part.
Precisely. By focusing on green ammonia feed studies, tech gets involved at the cutting edge of carbon-neutral technology, selling their expertise without immediately taking on the full EPC execution risk. It's pure co-creation engineering in action.
Selling the blueprint, not necessarily the whole building yet. That ties right back to Hosoi's strategy. Okay, speaking of high value, but also high risk the Americas, tech is heavily involved in FPSOs there.
Yeah, FPSO floating production, storage, and offloading units. These are incredibly complex, technologically demanding projects. Think massive ships that process oil and gas offshore.
Huge investments involved.
Huge. Tech does this mainly through their joint venture, Offshore Frontier Solutions, or OFS. They have major projects ongoing for giants like ExxonMobil in Guyana, Equinor, and Shell in Brazil. These contribute significantly to their income, often through the equity method accounting for their stake.
But these are exactly the kind of mega projects that can go sideways, right? Technologically complex, huge capital outlay.
Absolutely. They carry immense risk, and tech's history shows that. Their financial stability has been tested by these sorts of projects before.
Didn't they have a major legal battle related to a Canadian project a few years back?
They did. There was a big arbitration claim back in 2018 from Japan Canada Oil Sands Limited, JCOS. It was against Teck and their Canadian subsidiary. A major headache, even though Teck largely won the case in 2021. It just highlights how EPC work, especially internationally, is constantly exposed to disputes and cost surprises.
A constant risk factor. And what about China? What's their focus there?
Toyo China seems to be shifting focus a bit, less on the traditional big petrochemical plants and more towards supporting foreign investment in newer high-growth sectors. Think electronic materials, lithium battery components, pharmaceuticals, plus adapting to China's own push for carbon neutrality locally.
Okay, let's pivot to the financials now, because all this talk about risk, well, it really showed up in their FY 2024 results, the year ending March 2025. Revenue is up, but profits, not so much.
Yeah, that's the classic EPC pain point laid bare.
Yeah.
Revenue climbed to $278 billion, which sounds good, but net income, it plunged to just $2.0 billion.
Ouch, why such a big disconnect?
The usual suspects in high-risk EPC. Cost overruns on certain projects, delays, and this is key unresolved negotiations with clients over costs and changes. It's not just random bad luck. It's a direct symptom of the volatility that Hosoi is trying to engineer out of the business model.
And there was an asset write-down, too.
Yep, impairment loss on some fixed assets down in Brazil also hit the bottom line.
Okay, so tough year. But the forecast for FY 2025, ending March 2026, projects a really sharp recovery. Net income jumping back up to $5.0 billion. That feels optimistic, aggressive even.
It is aggressive. And that's the million-dollar question the market has, right? How reliable is that forecast? Have they really dealt with those problem projects from FY24?
So what's the basis for that optimism?
It really hinges on two things. One, the assumption that those specific problematic legacy contracts will stabilize or conclude. Two, and this is more strategic, the growing contribution from their lower volatility non-EPC businesses. They're banking on those higher margin services starting to really drive profitability.
They have a specific margin target for that.
They do. For FY25, they're targeting a consolidated gross margin of 13.3%. And that improvement is meant to come from that shifting business mix towards non-EPC.
Right, non-EPC. That's the key to stability, you're saying. What exactly falls under that umbrella?
It's all those higher value, less construction-heavy services we touched on. Things like technology licensing, feasibility studies, consulting, project management, consultancy, PMC.
Where they manage the project for the client.
Exactly. And also EPSCM contracts, engineering, procurement, services, and construction management. Again, more management, less direct construction risk.
And they have a target for how much profit should come from this side.
Yeah, it's a core part of the strategy. They want to get the gross profit contribution from non-EPC up from around 39% in FY24 to 50%, half their profit by 2030. It's a fundamental shift from being primarily builders to being knowledge providers.
And their proprietary green technology must play a big role here. They're not just generic consultants.
No, absolutely not. This is where their R&D comes in. For example, they have a system called Superhidix. It's a proprietary distillation technology that can significantly cut greenhouse gas emissions, maybe by 50%, in certain chemical processes.
So they can sell that as part of a package.
Right. Or their Hero services, that's for optimizing existing hybrid energy systems. When they bid on a project, especially a CN-related one, they're bringing these unique tools that help the client meet their environmental goals and often save operational costs, too. It's a stronger value proposition.
Okay, makes sense. Let's talk shareholder returns then. Given the recent financial turbulence, how are they treating dividends?
Well, it's been a bit rocky. They actually paid zero dividend back in FY 2020 after some earlier financial struggles, but they seem committed to recovery now.
What was the payout for the tough FY 2024?
They paid $25 per share, but because the profit was so low that year, that $25 represented a really high payout ratio, over 72%. Clearly not sustainable at that profit level.
But with the profit recovery, they're forecasting for FY 2025.
The plan is to keep the dividend steady at $25 per share. But if they hit that higher profit target, the payout ratio drops to a much more comfortable 29.3%. That's right in line with their stated fundamental policy, which is a 25% long-term payout ratio. So stability is the goal.
Got it. Now, we absolutely have to address the elephant in the room. The PBR, the price-to-book ratio, tech themselves acknowledge it's low, hovering around 0.5. Why is that such a big deal right now?
It's a huge deal, especially in Japan. The Tokyo Stock Exchange is putting enormous pressure on companies, particularly those trading below a PBR of 1.0, to improve their corporate value and explain how they'll do it.
And a PBR of 0.5 basically means the market values the company at half its net asset value.
Exactly. It signals a serious lack of confidence from investors in the company's ability to generate future returns effectively from its assets. It's a major red flag for management.
So what's their stated plan to fix it? How do you get the market to value you higher?
Their answer is crystal clear. Boost profitability. Specifically, they're targeting return on equity, ROE. That's the metric they believe will convince the market.
What are the numbers there?
They're projecting ROE to jump from a low 3.3% in FY 2024 all the way up to 8.1% in the FY 2025 forecast. And their midterm goal is to get ROE consistently above 10%.
So prove you can make good money reliably.
Especially through those lower risk, higher margin, non-EPC and carbon neutral services. And the PBR should follow. That's the theory. And it's worth remembering, they had to do major capital strengthening back in 2018, 2019, issuing preferred stock, restructuring capital.
Right, to shore up the balance sheet after previous losses.
Yeah. So this focus on sustainable profitability isn't new. It's a response to past pain as well as current market pressure.
Okay, so pulling it all together, what's the big picture here?
You know, at the end of the day, tech is attempting a really fundamental pivot. They're taking their deep historical technical expertise, especially in areas like ammonia and urea production, complex chemical processes, and trying to fuse it with this aggressive digital transformation, the DXoT initiative.
Leveraging the old strengths with new tools.
Exactly. And using their global network, especially those autonomous hubs in growth regions like India and Indonesia, to focus more on those lower risk, higher value services, they're actively trying to shed that old skin of the high stakes EPC gambler and become this more predictable, data-driven engineering partner chasing those massive carbon neutral market opportunities.
That strategic shift really does feel crucial. Stabilizing profits via non-EPC, aggressively going after CN work like sustainable aviation fuel, geothermal. It seems necessary for their long-term survival and relevance. The CEO's push for co-creation feels less like a buzzword and more like an admission that the old EPC model is just too risky in today's world.
It's a recognition of reality.
So, here's a final thought for you to consider. Tech explicitly needs to fix that low PBR by boosting ROE, largely through their green strategy. Now think about their unique technologies, like that ACES 21 LP urea process focused on efficiency, or those green ammonia feed studies happening right now in places like Indonesia. What if just one of those feed studies converts into a full high-margin EPS-FEM contract? Or what if ACES 21 really scales globally? Could that kind of tangible success start to shift the market's perception and their valuation, perhaps much sooner than people currently expect?
That's the key question, isn't it? Can they execute on that green potential quickly enough to prove the pivot is real?
Exactly. That's the transition tech is betting its future on. Something to keep a close eye on as this deep dive concludes.